This is a new segment that I'm going to call Q&A Tuesday. So what I want to do is I want to go to several videos from some of our friends on the YouTube space, answer some of their questions. Then I'm going to go in the Discord and answer some questions that you guys have left. And then I want to look at some of the questions you're leaving in the chat right now. And then I want to look at some charts. So if you want to put some charts in the chat, go ahead and put like Palantir long, Google short, Apple long, Netflix short, whatever. Just go ahead and put it in the chat. I am here to help you out as best I can. So let's go look at a couple videos and see if we can answer some of these comments on these videos here. So first one, this is one from Felix. This is what always happens before a stock rally. Stop losses hard, no less than 3%. So personally, when I look at a stop loss, I don't want a 3% stop loss. I think a 3% stop loss is really huge. For me, my stop loss is always the half ATR from entry, the half an ATR from entry. And so what that looks like is if you were to get into any stock, we can look at Palantir, for example. If you were to look at any stock out there and you add in the ATR, actually, I need to add that. So let's do that. In my favorites over here, I'll go ATR, average true range right there. And then we can see right here on the chart, this is the ATR. Now, ATR is a measurement of volatility. So let me move my fat head out of the way, and we can see the volatility has grown from about $1.40, $1.25 back in July of last year on Palantir. Now it's up at $6.80. So what is it? 5-6 times higher on volatility than it was just a few months ago. If you're trading the same size when volatility is 6 times higher, you can get to a whole heap and helping full of trouble. So what I do now, I learned this from the Complete Turtle Trader was one spot where I learned this from. But what I do is I take my opening, and let's say that I got in yesterday at 123.82, and then the ATR, the whole ATR is $6.84. So I take 6.84 divided by 2, $3.42. So then we go 123.82 minus 123.82. So my stop loss is at 120.40, which is tight, and it's by design to be tight. So 120.40, that's right, there-ish, right? It's by design. If you're trading big size, you want to have a tight stop loss. If you're trading a small size, you can have a bigger stop loss. But if you're trading big size, you can make way bigger returns, but you need to keep your risk in check, right? And so that's why whenever I'm looking to put on a trade, I go with the half an ATR, because I don't need much to find out if I'm wrong. A winning racehorse does not back up into the gate. A winning racehorse continues on. And right here, right? A winning racehorse continues on. And yeah, of course, sometimes it'll pop up and then come back down and you get stopped out. But that's part of the game. That's part of the game. The objective here is to go in with as big a size as possible and take the least amount of risk at the same time. That way you maximize your gains, minimize your losses. I hope that makes sense. Let's go to a question from the Discord. So over in our Discord, we have a Q&A questions from you section. I don't always get through all of these, especially because you guys have a million questions, which is awesome. That means you're learning and growing and improving. But let me see if I can find some questions that I can answer on here real quick. Minor Al says, after cutting through a new buy listing, I looked deeper into those left. Hang on, this is a really long question. I don't want to read all that. Not while I'm live. Okay. So Skinny Buff Guy had a point. You mentioned several times that your strategy is to trade options that are around 3 weeks to expiration. For sure. Correct me if I'm wrong, but I believe that you do this because extrinsic value is lower, which means the option costs less than the same strike price option that expires in 7 or 11 weeks. The intrinsic value is the same for both options, but the extrinsic value is higher the further out you go. My question is, why not trade the option contracts that expire further out anyway? Because if you're only going to hold for a week or so, the option's still going to keep most of its time value. Wouldn't the rate of time decay be slower at 7 weeks out than at 3 weeks out? So he's got a fantastic point. And so I want to go through this as an example. So for those of you who are somewhat newer to options, let's take a moment to explain what he's talking about here. First, the options, every option has what's called intrinsic and extrinsic value. Intrinsic is the moneyness. Intrinsic is the leverage investment that you own, right? Extrinsic is the time value. This is the part that will decay. Now, if every option has intrinsic and every option has extrinsic, a portion of that will be intrinsic, a portion will be extrinsic. Intrinsic is calculated by how far it is deep into the money. So let me log in my broker platform here, and I'll give a better explanation. Because I love options. Options are my jam. I went all the way down the rabbit hole with options. Sorry, just another 20 seconds here to log it in. Start live trading. Okay. So to his point, as you can see in the background, as traders loading, when you have an out of the money or at the money option, 100% of it is decayable. 100% of it is decayable. When you have a deep in the money option, and I consider deep in the money to be around the 80 delta, only 20% or so is decayable, sometimes less, sometimes more. But if you and I are starting at the same finish line, or the same starting line, we're going to end at the same finish line here with 0 on our extrinsic value. The difference is that 80% of what I paid for it will not decay. 100% of what you pay for it will decay. So we're going to look at AT&T, and we're going to look at around the 80 delta. So if I highlight that right here, that's the 25 strike right now on AT&T for July. If we go to June, the 80 delta is roughly, oh, the delta just disappeared on me. Let's go to May 16th. Ah, deltas are all over the place. They're like disappearing. Here we go. Okay, that is not helping me at all. That is not helping my explanation at all. See, it just disappears over there. All right, so here's what we're going to do. Because that's disappearing right now, probably because the market's closed, I'll do my very best to explain it as we go. In fact, I did mention this in my reply to him, so why don't we just go over there? Why don't we just go over there? So the May 16th 26 strike was $1.64 around the 80 delta. So let's start there. May 16th 26 strike here, 80-ish delta at the time. Then the June 20th 25 strike around $2.89. So June 20th 25 strike. That's around 80 delta. And now the deltas are there. I don't know. That was weird. And then let's go to July 24 delta, or I'm sorry, 24 strike around 80 delta. So first, you'll notice as we go, the further out we go to get to the same delta. And let me explain what delta is real quick. Delta is the rate of change in the price of the option for every $1 change in the price of the stock. So 180 delta option is equivalent to 4 20 delta options, right? So for every $1 the price of the stock moves, your option will increase or decrease by 80 cents. That's what delta measures. And so that's really my wheelhouse where I live at. Now you'll notice one thing here. The further out we go to get to the 80 delta, the further deep we have to go into the money. So we went from the 26 strike, the 25 strike, and the 24 strike. And one thing you may not have picked up on, which is kind of hard to do because you can't layer them, but each one gets more expensive as you go. And the reason behind that is you're getting deeper in the money. So it's growing in intrinsic value as it goes deeper in the money, right? It's growing in intrinsic value. And intrinsic value is calculated from the price of the stock minus your strike price. So for example, it's $27.51 minus 24 means your intrinsic value, your moneyness, is $3.51. And when you hear of people buying out of the money options and they're like, oh, I got to make so much money. It's because it went from out of the money where it had absolutely no intrinsic to into the money where it was growing. Okay. Absolutely no intrinsic, but it was moving into the money. So therefore it was growing. So here, $3.51 is $27.51 minus 24. Now every option has extrinsic value. And that in this case is 44 cents on the July 18th. And then if we go to the June 20th, it's extrinsic. So this is not, there it goes. Perfect. Is 36 cents on the 80 delta. So remember, it was, give it a second to calculate. Hold on. It was 44 cents of extrinsic on the 24 strike. We go here, we're at the same 25 delta, and now it's 36 cents of extrinsic value. And then we go here to the 26 delta, it's 14 cents of extrinsic value. So you're paying more for the extrinsic value as you go because there's more time. And you're also paying more to get to the same 80 delta because you're deeper in the money. So that is why, even at the same 80 delta, as you go out in time, it costs more money. So to his question is, why go with 3 weeks out versus 3 months out? And that's a valid question. First off, it's going to cost me less, which means I can buy more of them, or I can use less capital to achieve basically the same result, right? I can buy, how many can I buy? If it's 395, so 3.95 divided by 1.64, I can buy 2.4x, 2.4 times as many strikes for the same amount of capital. 2.4 times as many contracts, I should say, for the same amount of capital between these 2 points. Okay. They still both function at an 80 delta. They still both move 80 cents for every $1 in the underlying stock. And they still will both decay. But of course, the longer dated one will decay somewhat slower than the closer dated one. And that's because, like I said earlier, every stock has every option on every strike on every stock every time will decay to 0. Now, to his point, if you're trying to minimize the amount of decay, you can go out in time, but you're going to pay 2.5 times as much to do so. If you're trying to minimize the decay, that totally can work. Where my trades at maximum are 2 to 3 weeks, at the very maximum, most of the time, not even close to that. So I don't mind going closer to the expiration because I have no intention to hold until expiration, but I do want to pay less so I have other capital or more capital to work on other things. So super detailed answer. I hope that was okay. Let's jump into your questions in the chat. And so Shane asks, there's 3.0 automatically upload, or do I have to do that? So every day you log in to Outlier, it updates overnight. I believe it's 10:30 p.m. West Coast time that it updates. So this morning we have 44 new buy signals and 136 new sell signals. So there's nothing for you to do other than just reload the page. All right. Morning, Chris. Can you tell me which order blocks you use? There's so many choices. Do you have specific settings? From Shoei. So I actually am using one from our friend in the Discord, Rick Warfish. And I believe he's got it posted here in the TradingView Pine scripts. Deep Thought. Deep Thought is a genius, by the way. Deep Thought took Rick Warfish's and put it all into one single indicator. So TradingView, the free plan, allows you to have just 2 indicators. Deep Thought did all the work for you. And he took the 10, 20, 50 and the order blocks and the ATR and put it as one indicator in one giant Pine script. So that's where I would get it from. But I'm using Rick Warfish's, and that's what Deep Thought used to create his. A brilliant move, which allows you to have all the same indicators that I'm using, which aren't really all that many, just 3 moving averages and then the ATR and then the order blocks. All in one indicator, and then you can add one more. So I thought that was really brilliant. Great job. Danny says, Chris, when you say you don't trade into earnings, if you already have a position, do you close it before earnings? Outstanding question. Let's go through it, Danny. So for me, I don't want to trade through earnings because there's so much risk associated with it. So much risk, right? For example, Palantir had this giant move up. Looks like a 30% up move right here. Whereas I know Elf Beauty had a really devastating 25% down move right there. And that can happen to any stock. I don't know if you guys remember, but there were a couple years ago, I forget when it was exactly. Facebook had like a 40% sell-off. 40% when it was called Facebook. Now it's called Meta. 40% on a giant mega cap stock sell-off. That can happen to anybody, right? I don't want that to happen to you. So I like to trade up into earnings. And Palantir is a perfect example of trading up into earnings, letting it be what's called buy the rumor, sell the news. So you buy the rumor, hey, they're going to have great earnings, and then you get out before the news breaks. So my criteria is this. First, is the trade already profitable? Did I buy the stock and it's already profitable? Do I already have green in my P&L? That's what I want to know. Easy question. Next, does the expected move from earnings break the trend line that I'm following. And I always follow the 10 EMA. You could follow the 20, you could follow the 50, you follow whatever you choose, right? You make your own plan, you stick to it. So for me, my trailing stop is the 10 period EMA. So does the expected move break the trend line? Now you're probably saying to yourself, wait, how do I calculate expected move? That's a thing? That's a thing? Yeah, for sure. Let me show you. Let's go to Palantir. This Palantir had earnings last night. This is a perfect example. Let me change this to the all expirations. To find the expected move, you go to the option chain that's closest to after the expiration. So this will be May 9th, 3 days after. Okay. Now, what you do is you go to the at the money. So 124 is at the money. And you price out. Let me clear this order real quick. You price out what's called an at the money straddle. So buying a call, do not buy the options. You're just pricing it out. Buying the call, buying the put. What does an at the money straddle look like? Hang on. So a long straddle looks like this. So you bought a long call and a long put at the current price. When you do so, this is literally the most expensive trade you can make on the board. You're paying the absolute most in extrinsic value on both sides. Because look at this. Extrinsic value. Remember, this is the part that decays. You go deep in the money, there's less extrinsic value. You go out of the money, there's less extrinsic value. This is literally the absolute most expensive you can do on the board. And honestly, I think it's a huge waste of money. But people do this. I don't know why. I think it's dumb because you're paying as much as you possibly can. And then once we know what the earnings will be, the price of the options will go down 50%, 70% within 10 minutes, 20 minutes at the most. You'll see this trade, which currently at the market close had a price of $17.85. So if you really price that at $1,785 per one lot. Per one lot, $1,785. All of it extrinsic value. Within 20 minutes, this will be half of that price, maybe even 70% of that price. And the reason being is that at earnings, we don't know what's going to happen. As I mentioned earlier, you could see a 25% up move or a 40% down move, or honestly, you could have a 2% up move and a 0.25% down move. We don't know. So the market makers price these with this absolute maximum amount that they possibly can. And so by doing so, they're going to make sure that they cover their backsides if they're wrong. Okay. So if you bought the at the money straddle, that'd be $17.85, which looks like this, buying the at the money straddle. Now, because the market makers want to protect their backsides, they overinflate what the actual expected move is. So if it's 1785, what I do and what I was told and what I would learned was you take 0.85% of that. So 0.85. So 85% of the move, $15.17. Because like I said earlier, they are overinflating the options to really make sure that they don't get screwed as market makers. So you can tell about 85% of that is the rule of thumb for the expected move. So it's $15.85 up. So from here, $15.85 up and $15.85 down. Right about there. So when you look at this, right, the current price is the green line right there. The expected move is either up $15 or down $15, nearly $16 each way. So for me, if I'm following the 10 EMA, you can see that blue line right there. If I'm following the 10 EMA, it would absolutely break through that if the expected move did materialize. Now, could it be the expected move to the upside? Absolutely. But when you come from trading, you need to have a risk first mentality. Yes, it can go up $15.85, but it also can go down $15.85 or even more or less. And because of that risk, I'm not willing to take it. However, if I were following the 20 EMA, it actually would not break it. The 20 EMA is down here at 105. The bottom of this expected move is at 108. I actually would keep it on. I would keep it on because it was still $3 away on the expected move from taking out my trailing stop. Now, is that more of a risk? Yeah, for sure. But if I'm not going to exit until it goes under my trailing stop already, then it's a risk worth taking because I'm already profitable. And if it goes to here, then I'll get out. If it doesn't go to here, then I can write it. Long answer, but that's the way you got to think about these things, right? From a risk first perspective, what are we looking at? So fantastic question. Fantastic question. Let's go to another video and see if we can answer a question on that one real quick. Let me know in the chat. Type the word yes if this is helpful in the chat, or type the word no, I don't like this style, do something else. And it's not gonna it's not gonna hurt my feelings either way. I want to make sure I deliver you the best value. So this video from Joseph Carlson, 5 top quality growth stocks to buy right now. Can you do a whole episode on stock buybacks? Okay, so let's see if we can read this. Specifically, what is it? Where companies get the money to buy back stocks? Do they take on debts, issue bonds, or does it come from revenue? Where did the shares go? Does the company lock up shares and resell what they need the money? How does it affect the bottom line? Why do companies buy back when they can invest in new products? Oh my gosh, this person has so many questions. Let's just ask ChatGPT. Let's just ask ChatGPT. Here's what I'm gonna do. I'm gonna take this. I'm gonna drop this into ChatGPT, and because I'm a snob, I have the paid plan. That's one of my things, that I'm a snob. All right. Please explain stock buybacks. Let's get ChatGPT to answer us. What is a stock buyback? A stock buyback, also called a share repurchase, is when a company buys back its own shares from the public market. This reduces the number of shares outstanding. Where does the money come from? Excess cash / profits is the most common. Now, Apple is notorious for having assloads of cash. Apple's notorious for having so much cash. It's more than most countries have. And that's where they can use that cash right there, is to buy back the stock. This leftover cash after paying operations costs, etc. Some companies take out loans or issue bonds to fund the buybacks. And asset sales. Occasionally, they might sell parts of the business. I would bet that it's more about the excess cash. Okay, Apple, for example, has a massive cash. I didn't know I was going to say that. Has a massive cash stockpile. So it likely uses internal funds, not debt, for $100 billion buybacks. What happens to the shares? After buying, companies can either retire the shares, which is most common. So basically, if there are every stock out there has a specific number of shares that are traded. If there are less shares to be traded, the demand will be higher, supply and demand, right? If there's less shares to trade, demand will be higher for the shares that are left. So therefore, it can artificially boost the stock price. A lot of companies do that to help boost the stock price when they don't have a reason to boost the stock price. The shares are permanently removed from circulation and reduces the supply and increases earnings per share. Hold it as treasury stock. They're kept by the company, not counted as outstanding shares. They can be issued later or sold for cash in future. So no, they're not locked up and resold to raise money like a trading account. They can be used strategically. Okay, interesting. Why do companies do buybacks? Hang on. To boost earnings per share. Okay, that's what I was talking about, right? Fewer shares equals higher EPS. Signal confidence, right? So management might believe the stock is undervalued. I don't know about that. I don't think that they're going to be taking money off the table like that, but I don't know. Return value to shareholders. It's an alternative to dividends, I guess. Offset dilution. Now that I can believe. Companies use buybacks to offset shares issued to employees. So think of it this way. If you offered me 1,000 shares and I took those 1,000 shares, but then you took 1,000 shares out of the market, then it helps offset the fact that you just gave me 1,000 shares when 1,000 shares are in the market, right? So it's like inflation, right? The more shares you have, the less each share is valuable. So if you gave me 1,000 and you take 1,000 out of the market, then we're still even. Or lack of better opportunity, sure. How does it affect the bottom line? EPS improves. Wow, fundamental analysis improves due to fewer shares, right? So a manipulatable number here, which is why you need to follow the price of the stock, not the EPS. The income stays the same, but valuation ratios improve. Yet another fundamental that can be manipulated. Cash on hand decreases. If debt's unused, interest expense increases. Okay, why not reinvest instead? Apple could use that to acquire Epic Systems or another growth asset, but buybacks are often chosen because core business is mature, already very profitable. Epic Systems is private and might not want to sell. Buybacks are flexible and low risk, no integration issues, no need to justify ROI, so they can just do it. Final thoughts. Stock buybacks aren't inherently bad, but they reflect a company's priorities. Mature companies often lean into buybacks like Apple or Microsoft. Growth stage companies prefer reinvestment like Tesla and Amazon. Buybacks can boost stock price, but over-reliance may rely on a lack of innovation or bold strategic moves. So I'm very grateful that ChatGPT knew all the answers to that because I didn't know all the answers to that. And I am such a snob. All right, let's go back to one of your questions here in the chat. Everybody's saying yes, it is helpful. Thank you. Perfect. Let's see. Okay, Graham, can you please explain the portfolio size and sheet? I don't understand the number of suggested shares to purchase multiplied by the share price is often greater than the whole account size. Yes, that's what I was mentioning earlier, is that you want to be trading as big as you possibly can to get the most amount of gains, but you take as small of risk as possible. So let's jump into the portfolio sizing spreadsheet and I'll show you exactly what that means. And he's totally right. Some of these opportunities can be greater than 100% of your portfolio. Meaning you could go on margin. You could. Now let's explain how and why. Let's throw a few stocks on here. So like Palantir, AT&T's there. We can do HIMS. We can do hang on, where's my list? Let's do AMD, Celsius, and ELF. AMD, Celsius, ELF, and let's do a couple more. Coke, Meta, Microsoft. We'll do those. KO, Meta, Microsoft. All right, cool. So we got our list over here. Now let's remove the option price because we don't know what those option prices are just yet. But let's zoom in so this is a bit easier to read. So first off, be sure to fill out your account balance information over here. And if you want the spreadsheet, it's over in our Discord. So market posture is automatic. Account balance. This is just for example. You could put $1 million in there. You could put 10,000 in there. And then you need to figure out your percent risk per trade. Now, percent risk is not portfolio size. And we'll show you the difference in just a moment. Portfolio size is, hey, if I'm going to put on a trade, how much of my portfolio am I allocated to this? So $100,000 account, 50% portfolio size means $50,000 are allocated to this. That is not the same as risk. How much of the 50,000 am I willing to lose? I don't want to lose all that much, do I? I don't know, like 1,000? Cool. So your portfolio risk is 1%. Yet you could put on a size that's 50,000. Okay. You're risking 1% of your portfolio on a size that's 50% of your portfolio. So let me break this down a little bit deeper. So first it pulls in the current price for all of these. Now it's got some SPY correlations. You might find that interesting. Relative strength. Relative strength is a measure of average gain to average loss divided by the average gain to average loss of the SPY. So if I put in SPY right here, you'll see it pull in relative strength of 100 because that is the move of the market, right? So we're trying to see, like, for example, Microsoft has a relative strength of 193%, and it's grown in the last week by 13%. This is a relative strength chart right here. So let's do this. I want to show you Microsoft next to SPY. If I can figure out how to do this correctly. Here we go. We'll do SPY over here. Cool. Yeah, that double click on there helps me. So whoever mentioned that, thank you. So you can see in the last, let's zoom in just a smidge. In the last couple of weeks, right? Microsoft has been on gangbusters, whereas SPY has definitely had a nice bullish run right here. Do we see the difference here? Now, that is calculated. That move, if you quantify that move, is 193%. So basically, the move in Microsoft is 2 times higher than it has been in the move in the SPY. Pretty handy, right? I think that's interesting. And then it's increased by 13% in the last week. So last week, this was 186% now, or 180%. Now it's 193. Now over here, ATR, this is great. Look, the ATR changes so much between these. Now remember, ATR is your measurement of volatility. The higher this number is, the more volatile the stock. Like Tesla, as you would expect. Oh, I don't have Tesla on here. Let me put Tesla here. Like Tesla, as you would expect, is super duper high. Meta's is in fact super duper high at 22. I didn't realize Meta's was going to be that high. But then you've got stocks like AT&T, which has an ATR volatility of 72 cents. So for example, Meta 22 divided by 22.07 divided by 0.72 is 30 times higher. 30 times higher. Meta's ATR is 30 times higher than AT&T's ATR. Do you really think that you should have the same position size in AT&T and in Meta when Meta has 30 times the volatility of AT&T? No way. No way. Even if they were the same price, and they're not, even if they were the same price, you wouldn't want to have the same position size because one is so much more volatile. Okay. So if we look over here, we can see the half ATR. So that's taking the ATR value, dividing it by 2, and then subtracting it from the current value. Okay, so half of 72 cents is 36 cents. 27.51 minus 36 cents gets you 27.17. That's my stop loss point. My stop loss point here. Now, over here, remember earlier we talked about 100,000 and a risk per trade of 5%. You would think that that would be $5,000 of total risk, but in fact it's not, and that's by design. By design, supposed to be even less, because of course things can gap down. But if you expanded the ATR value, let's say you said the ATR was at 10, right? It's still going to make sure that your total risk is low. So the objective here is to take as little risk as possible with as large of position size as possible. So let's move on. The +1 ATR and +2 ATR are where I look to roll my options up to continue the trade on, beyond the scope of this question here. But share size in this, 3483. So that's taking, the math is, it's taking your account balance multiplied by your risk per trade. And then you're dividing that by 2 times your ATR value right here. So the formula is your account balance multiplied by the risk you're willing to take, divided by 2 times the ATR value. If you want to see what that looks like, it's right here. Account balance times risk divided by 2 times the ATR, and that'll give you the number of shares. And in this case, that's 3,483 shares. Yet you're only taking $1,250 in risk. How cool is that? The $1,250 in risk is the difference between the current price minus the half ATR price times the number of shares. Okay, it's current price minus half ATR price times number of shares. That gets you your risk. Pretty sweet, right? So $1,250 of risk is all you're taking to have 3,000 shares. Now, 3,000 shares times the current option or current stock price is how much? A lot, right? 3,000 times 27.51. So what was that exact number? 3,483 times 27.51 is $95,000. That's what that value is right here. 95% of my portfolio. So I could put on a trade. That's $95,000. $95,000. But I'm only risking $1,250. Because if I put on this 3,000 share trade when the price is at 27.51 and price goes down to 27.15, I'm out. I didn't lose 95% of my account. No way. I only lost $1,250. Isn't that cool? That is how you maximize your trade size. Now, I really want to get this very, very clear. If you do not respect your stop loss, let's say you had that stop loss on Palantir. Oh, geez, and it's down 9% this morning. Let's say you had your stop loss right here, opening to half ATR, and you did not respect that, and you decided to let it run. You have completely invalidated this. Completely. Because you're saying, I'm going to get out at 27.15, and now it's down to 27.05, and you're like, oh, I'll give it some more extra time. It should work out, right? No way. If you do this, and you go in with big size, you have to respect your risk. Have to respect your risk. Otherwise, you're going to get monkey hammered. But we can see right here, this is one reason why I don't want to trade earnings, right? It could be the best story in the world. And now it's down 10% this morning. Ugh, that sucks. Ain't nobody want to be down 10% on their stock, right? And we'll see if it actually hits that expected move. Pretty cool, right? We learned a lot today. We learned a hell of a lot today. So if you're ready to save time, make money, and start winning with less risk, be sure to click one of these two videos, and I'll see you in this afternoon's live stream. We'll talk soon.